Hey, welcome to the Airme Roundtable. Today is the 8th of December, 2021, and I have a special guest, Adam Grimes, with me. I've been following Adam's work for a long time, and I've learned to don't go against Adam's thoughts on the market because you'll get punished usually. So it's really nice to have Adam here. Adam, you've written a couple of books. I just bought them, in fact, so I still have
Thank
to
you.
read them.
Thank you.
But I really love your analysis every day, and I hope everybody else will agree and learn something today. So thank you again for coming.
Oh, you're welcome. And thank you for the invitation. And sorry, I know I was a little bit hard to get a hold of and schedule, but I'm glad we got things worked out. So, and I'm also excited about this topic and this way to look at the topic. I've given, I don't even know how many presentations over the years, but as I was thinking through this, your request was, I think what you said something like a lot of your members felt they kind of struggled with technicals.
Right.
And so I thought about a way to, I hope I have a useful way to look at this. I want to give you kind of a foundation for how I see the market. And, I appreciate your kind words on my analysis. I don't know that you could never go against my market calls, because I guess one of the things that I've really realized is that this is all only valid within the bounds of probability. But I do think I've developed a tool set that has kept me on the right side of the market and has been very useful in many different contexts. And it's not so much about what indicator or what tool. We'll talk about that, but this is a way to see the market. That's what I hope to share with you today. So here's, you see on your screen, and I'm not going to read everything on every slide, but I'll sort of try to stick to my presentation, which is good because I'm one of these people and I'm already doing it. As we're talking about something, I'll tend to end up in multiple nested parentheses, and if I don't have a presentation to hold me true, who knows where we'll end up talking about. But what I want to cover today, I do want to show you technical tools, and as I said, even more than that, a perspective that I have found useful over the years. And what makes this really useful to me is that what we're talking about is not so much patterns, but it's the way the market moves, it's the way the market works. And my belief is, and I'll explain why, I think these are very reliable things that we can build the foundation of our trading systems on. And more than anything, I hope to share with you my framework today, which has been really useful to me over the years. So a little bit about me, if people don't know, I've traded since the mid 90s. I've done some other things on and off through there, but I've traded professionally for most of that time. And I wouldn't say that I'm unique, but some things that are kind of unusual about me. I've traded everything, currencies, stocks, options. I've traded everything that is liquid and is available to most at-home traders. Of course, there are exotics and things that I haven't traded, but I've also traded like a lot of commodity spreads and stuff like that. And I've done everything from, I spent many years of my life trading a 1 to 3 minute chart, and did that successfully for a while. And recently I focused more on swing trading, but I've just been all over the time frames. One of the things that I think is both challenging and also kind of eye-opening for people when they start looking at my work is I'm a discretionary trader. And one of the things I think maybe the next few years might bring, we're looking at doing some more rigorously quantified systematic stuff. But in my heart and soul, I'm a discretionary trader, but this is built on a pretty rigorous statistical and quantitative foundation. And I'm not going to dazzle you with a ton of math today. And some of you have much better math backgrounds than me. I can't dazzle you, but we're not going to get too deep into the weeds with that. But I think you'll see how that works. Primarily a technical trader, and we probably should have a word or two about fundamentals. The reason I'm a technical trader is because I have found that technicals are what is relevant for my time frame. And I've done a ton of quantitative work on fundamentals, and I can tell you there are things that work out there, but I think a lot of the things that a lot of the, let's say, off the shelf fundamentals. So if people are looking at, for instance, PE ratios and things like that, they probably don't work like people think they do. And the thing that was truly eye-opening for me when I started testing a bunch of this stuff is that fundamentals start to get interesting. By interesting, I mean you can see a statistical edge to them at much longer time horizons, 3 months plus. And of course, that makes sense if you think about stocks, earnings come out quarterly. It's probably something to do with it. But I would encourage you, I'm always thinking about things that people struggle with. And if you're a person who looks to be in and out of a trade in weeks, so, say a 2-month holding period is a long time for you. And if your system hasn't quite come together and you're looking at a lot of fundamentals, I would encourage you gently to maybe start focusing a little bit more on technicals, because my experience in both practical trading and testing is that in the shorter time frames, technicals really do truly rule. And I've traded for myself, and like as it says the bottom slide here, a bunch of different places on the NYMEX for a while. Also, just a little bit about me as a not trader, because I think this colors my market perspective in some ways. I had a pretty decent career as a classical musician, as a composer and a pianist, and for those of you who are into, say, modern classical music, and I'm fully aware of the silliness of that label, but if you're interested in that kind of thing, you can check out some of my composition work at adamhgrimescomposer.com. I expect to be doing much more of that. I also have a pretty rigorous food background, and I still cook. I spent some time in a professional kitchen, did an apprenticeship, and still spend some heavy duty time cooking at home. If you want to know more about me, Twitter, I haven't been using Twitter much lately, but I promise I will get back to Twitter. So follow me on Twitter. That's what I have tended to use in the past. It's kind of a central hub for the things I put out. I'm Adam H. Grimes on Twitter, also on Instagram. Though if you go to Instagram, what you're going to see is primarily my food. So if you don't want to see that, don't go there. My blog is a good resource, adamhgrimes.com. There are literally hundreds of thousands of words, articles I've written over the years on many, many topics. Some of the things we'll talk about today, trader development. I think I know that we could kind of repurpose the blog and put the blog together and create several books there, and it's all out there for free. And if you also if you Google my name, like let's say you want to know what I think about Fibonacci ratios, you can Google Adam Grimes Fibonacci, and it'll probably pull up some links on my blog. Google has a pretty well indexed, obviously. As Tom mentioned, I also have a couple books which you can just check me out on Amazon. Free trading course at MarketLife.com. This is a pretty extensive course, and it's pretty rigorous, but it is all out there for free. And I do run MarketLife and Talent Advisors. Okay, so that's me. Interesting or not, I don't know. But I think how I got started with this and how I came to the things I'm going to share with you today. So I started trading in the mid-90s, and I like to tell people, wherever you're starting, you could not know less than I knew when I started. You could not be more ill prepared for success in the market than I was. I knew nothing. Yeah, I read some books. Just kind of jumped in and had no idea about leverage and risk or how any of this worked. To put it in context, I was trading on the daily chart, full-size commodity futures. About a $3,000 account was my first account. This was back in the days of the full-service brokers. I was paying $100 a round turn, give or take. No chance of success, right? Blew a couple accounts, but something about the process of trading and the way markets work really clicked with me. I can't, you know what it's like. You find something that just speaks to a part of you on both an intellectual and emotional level. And I was working as a musician at the time. People speculate maybe there's some pattern recognition stuff. I kept at it. I was lucky to kind of stumble into some good mentorship with some people who helped me out. And eventually, after no huge appreciable success, but a lot of struggle, a lot of trades, I happened to be day trading during the Asian financial crisis, trading the British pound futures, and did pretty well, and leveraged that success over the years into other markets, other approaches, S&Ps, and then into longer term trading. But I was always in some ways, I guess, risk averse. And I looked at the success that I had trading, and the question I'd always ask myself is, well, can you really depend on this? Or, these, of course, many of you struggle with this, right? These are the questions that keep us awake at 4 o'clock in the morning when you say, maybe I just got lucky. Maybe I've been just getting lucky. And you're always kind of wondering that. And this has led me to, I did not have, when I said you couldn't know less than I did when I started trading, my formal education was as a musician, and I also had a degree in comparative religion and, kind of bordering on philosophy. And what you notice from that is that that's maybe a foundation for an interesting person in some ways, and a person that does have some skills. But the person with that education, let me tell you the skills they don't have. They don't have math skills. And I had one math class in university, and it was, jokingly called Math for Poets. We talked about math concepts and how we felt about them, essentially. So I had no quantitative toolkit, and I had to learn statistics, and basically I had to learn math, and I enjoyed that, but that was a pretty big process that took many years for me to build any kind of foundation there. And one of the things I noticed is I started to be able to do these tests and to do these explorations and coding systems and things. I would see that a lot of the things that people talked about just didn't work, but people were saying they were making money. And of course, you hear this, maybe it doesn't work for you, but the implication is somehow that, and sometimes the implication is pretty clearly that, well, you're stupid, or you're doing it wrong, or, it's your fault. And in some cases, that might actually be the fact, because as we know, it's not really a topic today, but trading is a very personal thing, and you really do have to have a set of tools that click for you as a whole being, for your personality and risk management situation. But a lot of things I saw that people in the trading community were talking about weren't really very well nailed down and quantified. And that became my obsession. And it was a full-on obsession, I would say, for more than a decade, that I was really asking all of these extremely annoying questions. And I do think I'm probably annoying to talk to sometimes, because someone will share a trading idea. You ask a lot of questions like, well, how do you really know? What does, so we want to know if something works. Well, what does that even mean, that works? How do we know it's going to keep working in the future? How's it worked in the past? And one of the questions that, I'll tell you now, the answer to this, I think, is pretty definitely yes. Is it really narrow to only look at price? In other words, there are all these people trading in the market. Can we ignore the reasons they trade? Can we ignore macros and fundamentals? And I can tell you the reason I can answer that with a high degree of confidence is because even today, I do a lot of macro analysis. I have a lot of macro models that have worked pretty well and have helped us navigate these past, I don't know, especially past couple of years, but more than that, the whole bull market here for the past 12 years, whatever. And at the time, I'm looking at all of this macro data and still seeing that I really get the truth from price. So I can tell you that if you're on the fence about that, if you're thinking, gosh, I really have to incorporate exogenous data, I have to incorporate whatever jobs reports, whatever, you really don't. What I'm showing you today is a complete way to look at the market. So, as Tom said, some of you are less than confident about your relationship with technical analysis, and you want to learn technicals. Well, the way this usually starts is, and you've been there, you've probably all been there, you've certainly seen it on message boards. What's the best indicator? How should I set up my chart? What parameters to use for my indicator? Do I use a 9-period or 11-period RSI? People get very, very passionate about those. What's your favorite pattern? What patterns do you you look for? What patterns do you like to trade? How do you execute around your patterns? This is what people think technical analysis is. And these are questions that ultimately we have to answer, because you do have to set up your chart. And I don't have a slide on it, but I will certainly share with you how I set up my charts and why. But I don't think this is the way to start, because I don't think these are the most important things. And what I've thought about over the years is a way to really think about technical analysis from first principles. What do I mean by that? Well, the idea is, how does the market really move? And I related the story, I think, in one of my books. I was, I don't want to give you any idea that my trading career was a clear and easy path to success. There were a lot of ups and downs, and the downs came very reliably. This is quite interesting. I would tell you that I trade basically the same approach on every market and every time frame I trade. But as a discretionary trader, I know I'm making a lot of small adjustments. And the reason I can tell you that is because every single time I went into a new market, I struggled, sometimes mightily, sometimes with a great deal of frustration for a long time. And I remember one of these points where I was really just practically kicking holes in the wall. I said to a friend of mine who was a very experienced bond trader, traded in the pit for a long time and was now a broker. I said, I'm just so frustrated. What I'm doing is not working. And he said, well, the reason it's not working is because you're not trading, you're not respecting how the market really moves. This came after several years of trading. I said, wow, that's a very interesting, it's a very interesting point. How does the market really move? And he thought for a moment. He said, I guess I don't know. So answering that question is quite important. How does the market really move? And I do have some answers, which I'm going to share with you today. I'm not just teasing. This is kind of saying the same thing, because if we understand how the market really moves, then we have some sense of what we can both understand and maybe even predict about the market in the future. These might, understand and predict might not be the same thing, but they're certainly yoked together in some very interesting ways. And this also gets us close to those questions that I said you probably all are starting with. Are there any patterns? We might say patterns because we might be looking at a chart. We might be working from a more code-oriented perspective. Are there any conditions that can say something about what the market is going to do in the future? And I know many of you here, of course, focus on options, and it's also interesting that some of these patterns might not be extremely informative. Let's say that there might be patterns that don't really tell us a lot about market direction, but they can tell us something about volatility. And that's quite interesting too. And there are some trading opportunities there, perhaps for some people. And are there useful ways? And this is one reason why, despite all of the many, many thousands of lines of code I've written, this is one of the reasons that so much of my work has remained visual, because we can put these highly quantitative concepts into packages that really click with, I say human perception here. That just means you see it and you know it, and it's not, it's not sloppy. This is a real thing, and eventually maybe even help to foster some intuition. To think about how markets really move, you got to think first of all, and we won't get stuck here, but markets don't exist so that we can make trades. Okay. Everybody realizes that, but I would encourage you, if you have not thought about this, think about why. Just imagine like you end up marooned on a desert island with a few hundred people and you set up a society. Eventually you're going to need markets. Why? Well, to help people trade, to help farmers, maybe they sell their crops and they get wood in return from carpenter, for instance, but also to figure out what things are worth, this process of price discovery. This is basic, but it's very important. And one of the keys here is understanding this is a very competitive environment. Also, our modern markets produce a pretty clear record of transactions. And this extends back to antiquity, by the way. Some of the very, very earliest writing we have in a script that I think is called Linear B, which predates written Greek, but they're price records. These people kept massive records of massive economic records. And we can't read some of them. We can read a lot of them. But one of the interesting things when we do look at the record of price movements, and as I said, the data is out there stretching over a very long period of time, we find that price movement is often random. Now, people hate this word. I've gotten a lot of pushback over the years from people who will say things like, okay, wait, here's one of the arguments against it. I say markets often move randomly. Your response might well be, well, wait, that's not really possible because people don't trade randomly. You have, everybody who places a trade, they place it for some reason. So therefore, the markets can't move randomly. I would gently point out that that argument is false, because you could have many people who each are acting with some agency and some interest, who, and their actions counteract each other enough that the outcome, the net result, the price movement is random. And we could talk about that a lot more. And then this is actually a pretty good question. Okay, Adam, well, you say it's random. How do you know that? Can you prove that? This all needs careful consideration because it's so very important. When I say the market usually moves randomly, and that's, if you ask me, like put on a fortune cookie, for instance, like what's one thing you can tell me about the market that is true? That's one thing I would tell you. Market usually moves randomly. And what I mean when I say that is that it's unpredictable. And now let's notice, of course, that random data can have a drift. So stocks, for instance, if you close your eyes and dumbly buy and sell stocks, what you'll find is that your return is about 7% a year over a long time period. And that's just because on average, stocks go up 7% a year. And this means on average, stocks go up every day. And of course, on average hides a lot, right? But random does not mean zero baseline outcome. And this is one way that people get very confused. I've had, I don't know how many traders over the years come to me and say, hey, look, I have this great system. And when I test it on stocks, it makes 5% a year. And, then the person's thought enough to know that if they have a 5% edge, they can apply leverage and make that bigger. And they think they really have something. And I've seen pages and pages and pages of work like this, but what that person doesn't realize is that you're not 5% is something, it's not zero, but you're not comparing to 5%. So what I would then tell the person in this case is, okay, here's your data, here's what you've tested it on. Go back and assume you randomly buy and sell, create that system, or just buy and hold. And what they generally come back and discover is, oh, I would have made 7% ish buy and hold. So, this doesn't actually have an edge. So random data certainly can have a drift. It does not mean zero. And also it has a distribution, like we know something about the associated in price terms volatility. For instance, the S&P is probably not extremely likely to go up 20% tomorrow. It's probably more likely to go down 20% than it is to go up. And it's probably not very likely to go down 20%, but that possibility does exist. And so random doesn't mean that it's completely unpredictable, but even what I've just described, if you were to try to trade with just that knowledge of distribution and drift, you could not beat buy and hold. And if that's true, then you should just buy and hold, and the indexers have a powerful argument. Do be aware that a lot of times people look at something and say that can't be random, and it's just because of the way our brains misfire. It's not because anybody's uneducated or, it's not because of emotions. It's because on a very deep level, we don't deal well with randomness. And I've become convinced that this is, and we're spending a little bit of time here because I think it's profoundly important. So many of the problems traders struggle with really come from not understanding the impact of randomness. Also, so you might come at me with the question of how do you know it's random? That's a very good question. The answer is I don't. I can tell you something is probably or is probably not random, but that's only within the bounds of probability. And if you want to think about that, one way to think about it is, what if I'm flipping a coin and it's a fair coin, and I give you say, okay, look here. I've been sitting here flipping this coin, and I have heads, 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 heads. What would I just say? I don't know, 6 heads in a row. And I would ask you, do you think that is random? And you'd probably look at it and say, no, it's probably not random. But of course, you don't know how I got those heads. What if I've been flipping the coin 1,000,000 times? And what's the likelihood that I'll have a run of 6 heads if I'm flipping the coin a million times? It probably happened. In fact, at some point, it'd be surprising and probably tell us it wasn't random if we didn't see the runs. So there's actually quite a lot of all of this does really, there are epistemological questions here, and they're fairly sophisticated. So people who ask these questions are probably asking fairly deep questions that do deserve some respect. But why do we care about all this? Why am I spending time talking about this? Practically, here's how I think about it. And this comes from my experience trading and teaching, training traders. I've come to the conviction that randomness is really the enemy. It's appropriate to think, the other traders, the market maker, those are not your enemy. You yourself, maybe in some cases, you are your own enemy. It happens. But most, even if you become your own enemy in trading, which we've all been there, I've certainly been there more times than I can count. What you probably were provoked into being your own enemy. We're talking a little bit about psychology here because of randomness in the market that you misperceived. And as I said, if something's random, you can't make money with it anyway, and you're really tilting it windmills to try to do that. It amazes me still, one of the wonders of the human mind. We do so many things so well, but our intuition around and about randomness and about probabilistic outcomes is extremely poor. And I think we've seen this in much of the debate over the COVID struggle. I don't pretend to be able to tell you what the truth is there, what you should or should not do. I don't know. But the degree of emotion and conviction, what I would say would be false conviction on both sides, that is swirling around this, to me, is just a very real world illustration of how poorly we deal with uncertainty. And this is a big part of the trading struggle, to untangle what's real from what's false. And as I said, this is how you become your own worst enemy here. So this matters when we start to look at market data, because the whole point is to be able to pull out what I would say is non-random price action. Now, I told you I'd put on my fortune cookie. What's the truth about the market, Adam? The market usually moves randomly. Fantastic. We can't do anything with that. That's not very helpful. So you walk away disappointed. But the point of that is the market usually, that's the key. That's where it all hinges. The market usually moves randomly. So the question is, can we pull out these points where the market is somewhat less than random? And this is hard to do. The answer is yes. It's hard to do because, as I said, in this competitive market with all of these different people fighting and trading for different reasons, there's such a degree of noise that it's difficult to see through that. And we do need to really understand these things. We have the right tools to see these things. They exist, but they're not the tools that most technicians are going to think about. Most technical traders will jump in and start talking to you about trend lines or indicators. Those are useful tools. I use both. Don't use both a lot, but I do use both. But underlying all of that is a way to, and this would be many presentations to get into this, but a way to drill through the data and look and see what is actually signal. I'm going to give you in a moment some patterns that you can look at. And if you do have statistical skills, it's interesting to take some of these and just take a price series like the S&P and qualify the data with some of these tools I'm going to give you, like a big move in the market's one place to start. And then you start asking the question, well, okay, so let's just take that example, big move. You obviously have some way to quantify a big move, but let's say you do. Once you've quantified the big move, it probably makes sense to say, hey, what's the market look like, to do some statistics and say one way we might do is to say, what's the average return of the market? And then what you can do is just create kind of a simple test, what we might call a bin analysis, and say, let's pull out the days following that big move from all of the other days, and do they look different? There's a lot of ways you can make mistakes here doing the test, but that's really the essence of it. It's not complicated. It's, as I said, there are many pitfalls and ways it can go wrong, but I think the core of what we're doing when we look at things mathematically is relatively simple. We're saying, what does everything look like if you just randomly blindly bought or sold on any given day, versus what if we were to only buy on the day where we have this condition? And then you ask yourself if it truly looks different. Now, I'll tell you why this is important, because what I just described, if you're trading, that's what you're doing. You're only taking trades when you have this, when you have these conditions. So you're going to, your trading account is going to become a statistical test. It's a little bit hard to say that word before noon. And you get to choose if you've done the foundation work to make that a successful test. General advice I would tell you, if you are interested in doing some of this testing yourself, there's a lot of value in doing work by hand. I do a lot of coding. Python's a very good language. R is also good. TradeStation, easy language. Yeah, there are multiple scripting languages out there. I think there's a lot of value in saying what happens over thousands of occurrences, but there's also a lot of value in sitting down with a chart and working by hand, doing some old-fashioned counting, if nothing else. If you do get into this, you really want to be careful about data snooping bias. One of the ways that I would suggest to avoid that is you don't want to, for instance, let's say you want to test RSI. I think it would probably be a mistake to test 20 different values of RSI and then pick the one that looks best. And then maybe take that and then add a stochastic onto it. This is an example of how to do a bad test. You can get a test that looks very good if you kind of go through these steps, but won't really perform very well. It's a lot better to have an idea. And the large move that I mentioned, if a market makes a very large move on a day, that probably was not a random event. It could have been, let's be honest, right? But it probably was not. And if we test a lot of those big moves, then we'll probably pull out a set of days where there was something non-random going on. And what this will likely do, or could, we got to be careful about our language. What this certainly could do is give us a reason to think price movement might be less than random going forward. But see, there I had the idea first. And yeah, I know, for those of you who know about machine learning, there are algorithms that do exactly what I'm saying don't do. As far as I know, they also have not been wildly successful. And I think if you try to apply one, yourself, it won't be too successful. Also, one thing I can tell you from this happening literally hundreds of times to me, if you find the holy grail, if you find something that looks too good to be true, it's not true and you made a mistake. And if this is the beginning of your journey, if you've done this, you're nodding and smiling and you already know. If you haven't done this kind of testing, remember I said that. You'll be revisiting that in the future. So bottom line, price movement is not always random. And the key is being able to tell when it might be something less than random. And there are patterns that give us this information. And sorry, I have a slide. This is out of order here. I'll come back to that in a moment. If we think about nailing down this randomness a little bit more clearly, probability is the weapon you need. And this is why so many of the good books on trading psychology, so many of the people who speak with clarity on the issues of trading psychology focus on the fact that you need to think over a large set of trades. And most of us know this, but then it can be very easy to get frustrated when you have two losers in a row, for instance, which, by the way, always happens to me when I start a new trading program or a new idea. I just know it's going to lose at first. It's almost funny, but it does happen. Probability really is the key to collapsing all of this uncertainty down. And, I think about it. This is really kind of interesting. Unmanaged randomness is chaos. And probability is the tool that allows us to reach into that bag of chaos and create some order. The market is chaotic. The market is essentially random, essentially unpredictable. If we have the right tools to look at the market, then we can create out of that. So, okay, it's very philosophical, right? That's nice. What do we do? Okay, here are examples of the kinds of patterns that I found useful. A large move. Now, what does that mean? Single bar, multiple bars, or a sustained large move. So sustained, I guess, would be multiple bars. But you do have to have some way to quantify a large move, and your eyeballs, your Mark 1 eyeballs, are a pretty good tool for that, because you can simply look at a chart and say, this move looks like something I have never seen before. And particularly if you put the right kind of structure on the chart, this gets even easier. I prefer to, there's something I use called sigma spikes, which is you have to be careful. It's a standard deviation, but it's a standard deviation. It's the move compared, today's move compared to the baseline volatility the past 20 trading days. Now that's a short baseline, 20 bars. If we use it on weekly or monthly or 5-minute, we still use the same 20 bars. So what you will see with this, if you've had stats 101, you're thinking, oh, a 2 standard deviation event should occur, X% of that. There are all these rules of thumb. They absolutely do not apply here. You will see with this some, if you believed in a normal distribution world, you'd see like some 15 standard docu, for instance, had a, 15 standard deviation move a week or so ago, and that would never happen if you're under a normal distribution. Well, this is not that. What the sigma spike gives you, you can just Google Adam Grimes sigma spike, you'll find on my blog the whole thing. There's several articles, but I've explained exactly how to calculate it. It's just a ratio. I think you could accomplish the same thing with looking at today's move as a ratio of some kind of range related thing, or maybe just like an absolute average move, something like that too. So I like to have some way to quantify it. You could just use a chart. Other ideas. This is a complete trading system in itself if you are extremely patient. You don't get many signals. But in stocks, if you have a large move on very high volume, what's very high volume? I don't know, let's say 4 to 5 times typical volume. That move will tend to bleed in the same direction over a large sample size. You could build a trading career on that approach and sentence. Wouldn't necessarily be easy, but that is an enduring edge. This is a little bit harder to pull out, but change in the balance of mean reversion trending action. We haven't talked about that, but I do believe that this, I'll show you in a moment, that this is really the structure that I see everything within, is kind of this balance of mean reversion and momentum. Volatility, contraction, especially following a large move. Let's look at some of these. This is a large move. This is the infamous large move that began the COVID collapse last year. And, if you just look at the chart, you'll see that this looks not radically different than anything we'd seen before, because if you go back here, this looks similar, but it's pretty clear that this is a move that deserves some kind of attention. Now, I find it's very useful, and I use on all my charts, and I have for literally decades, a 20-period exponential moving average with Keltner channels set 2.25 ATRs. So I can't really draw well here, but 20 EMA, XMA, and then Keltner channels with the band set 2.25 ATRs. You could use Bollinger Bands. You could use any tool. I have reasons that I explained in some detail in my first book why I prefer the Keltners, but what I would think you should probably not do, and I want to be careful telling somebody what to do or what you should do, but I think if you are always changing these values and putting different things on all of your charts, I use the same thing on even every time frame, because it trains your eye to see, and it structures the market data in a way that I think is very powerful for intuition. That is my primary indicator. I find it difficult to trade, probably impossible to trade, if I don't have those tools on the chart. So if you're asking me where to start, I'd put an intermediate term moving average. I don't much care whether you use exponential or simple, and I would put some kind of band around that moving average. And I think it's best if that band is sensitive to volatility. There are also, for instance, percent bands where you just draw a band 5 or 2%, above and below the moving average. It's probably better than nothing, but it does make sense to me, particularly for options traders. If you have something that's going to get wider as the market gets more volatile, kind of makes sense, right? So that's why both Bollingers and Keltners are pretty good tools. The other things you see on this chart here, this is a modified MACD, which a lot of people call the 310 oscillator. And this is a tool that goes back to the 1980s, at least. It was an old tool. A lot of people use this. Again, that's explained on my blog. There's no secret here. It's just a 310-16 MACD with simple, this is the part that might be difficult to do in some charting packages, with simple instead of exponential moving averages working in the MACD. And then down here is the sigma spikes I discussed, but they're filters, so they only show large moves. I think what we're showing here are probably moves bigger than 2.25 sigma on a day. And you can filter those or not. So, but this is an example. This idea of just looking for a large move. When you see this, it's enough to say, maybe there's something going on in the market I should really be paying attention to. Here's sustained large move, multiple days. Here's an example of a sustained large move that's a little bit more subtle. And here's where the bands can start to help you. Because if you look here, as I said, it's subtle. We're not touching the band here, right? Here, we're kind of chopping back and forth and we're around the moving average. Look what happens here and here when we go down to the lower channel. It's rejected. It pops back up. Looks like kind of the same thing that happened here. But here now we've started to have sustained pressure against the upper channel. You might say we had it here too, and I think we did. But of course, now I'm going to clear these marks. Nothing works all the time. This is crude oil at the beginning of this year, and you can go back and look at what happened since then. If you don't know, this was an early warning that we saw in real time that we would see continued price pressure in crude oil, and it gave us strong reason here right back at the beginning of 2021 to start leaning on the long side crude oil. This is a pattern that I find very, very powerful. If you have a market that makes a big move, this is actually not the stock I was referring to, even though the ticker is similar. And then the market kind of sits there. This forecasts within the bounds of probability, a continued move in that direction. So what we're doing here is really just capturing a few of these fundamental elements of market behavior. Now, we aren't really talking about chart patterns. We're talking about the price movements that create chart patterns. And I do believe that these price movements that create all the patterns we look at, whether on a chart or on an indicator, it really comes from the interaction of the forces of mean reversion and momentum. And mean reversion is simply the tendency for a market, if it makes and you know this, and most of you know this, makes a big move in one direction to snap back over some time frame. Momentum is exactly the opposite. If a market makes a big move, momentum can actually mean several different things. It can just mean relative strength. But in this sense, what I mean is that a market makes a move and then continues in the same direction. These are obviously conflicting forces. And when we look for patterns, what we're looking for is some evidence that one of these forces is going to win in the future. And we can trade around that. That gives us enough of an edge to trade around. If you want to quantify these, here are some things you can think about where you will find mean reversion. I'll show you a couple tests here, but I don't want to get too deeply into the weeds. Fading large single bars. So this means a market is kind of chopping around doing its market thing, and then makes a big move, and then will tend to snap back. That's the tendency you're trading. Fading in-day runs. So the market goes 3 or 5 bars in one direction. You also could do this by looking to fade breakouts of channel highs or lows. You could look to fade large excursions from moving averages. Well, that sounds very academic, but many of you know there are tons of systems that look to, it's typically done around Bollinger Bands, but if it goes up to the upper band, you'd look to short and vice versa to the bottom. What you find is if you test these, you'll find usually a large range of parameters works if the system actually works. So one of the things that I would call into question is if I used to like calculate things out to the nth decimal place, and I don't know there's a whole lot of value in that. It's more understanding the concept, which is, I think you see this is my framework for technical analysis, is understanding the concept here. I'll show you just a moment here. Different asset classes and time frames have different tendencies. Now, this is a wash of numbers. We could spend a lot of time talking about this, but what I have here are 6 separate tests. So the columns are, you can see stocks, futures, and currencies. And then the top are buys and the tops are sells. So what we're looking for here with that sigma spike tool I discussed, if we have a sigma spike up, so you have a 3 sigma close up, we're going to say what would happen if we were to short that close. Now, I'm not saying you should do that. This is just a test of tendency. But what you would find is if you did that with stocks, here's the return. And these are in basis points, so it's 0.18% up to 20 days out. And you see a quite persistent, this is a nice win, right? A quite persistent negative return for that with the sells. The buys look to be a little bit more complicated, don't they? You have a very strong tendency here for the first few days that then seems to decay. But keep in mind, if you're buying, positive is a win. Negative, if you're shorting, would be a win. But you can also see, and here's where people get in trouble, and you can look at this slide, spend some time looking at this slide later. Futures don't look like stocks. So we need to be a little bit careful applying the same tool to every market, right? Here is putting a 100-day channel on stocks. If you were to short 100-day highs, I'm sorry, if you were to, so this is the, I got to explain this clearly. Sorry. This is based on buying a breakout of the upper channel, which actually turns out to be a loss. So the correct trade would be to short the upper channel in stocks. So you have a negative return here, and the correct trade would be buying the lower channel. And again, don't get too caught up in the numbers. Just notice that what I've highlighted here on top are consistently negative, consistently positive on the bottom. But look what happens again with futures. So here's where people sometimes run into problems. You can't necessarily just apply the same tools, the same approaches to all markets. As I said, I think I do, but I know that there are patterns where I might look to short something in stocks. I would never do the same in currencies because I know this tendency for mean reversion is different. By the way, many trading systems, there are a lot of fundamental approaches that kind of have some technicals thrown in. And one of the common technicals is look to buy stocks that are at or near 52-week highs. Well, this is not 52-week highs. This is 100 days. But if we replace 100-day with 252 days, you'd find the same tendency. So if you're buying stocks that are at 52-week highs, you are reliably putting yourself on the wrong side of mean reversion. And that's a painful thing to do. However, what you would discover is that stocks at 52-week highs tend to kind of run out of steam and make a pullback, and then they do continue higher. So if you're trading, here's a case where time frame really matters, because if you're buying stocks that made 52-week highs today, you're going to lose over the next month, statistically speaking, if that were your only criterion. But what you would find is a couple months later, you'd very likely be higher. So there's probably something you can do with that, right? Worth thinking about. So you see here, here are ways that I take these kind of nerdy, apparently, what we're talking about technical analysis. What are we doing with this, right? It just looks like numbers. But what these do is tell us things about the way the market moves that then we can encapsulate into trading ideas. I don't know about you, but that's pretty exciting to me. Momentum's a little bit harder to quantify, and I don't want to get too stuck here, but I will tell you, if you're asking me what chart patterns do I trade, my bread and butter trade is a pullback. And here's a very simple test of a pullback, which you can do better than this trading, but this is a blind quantitative test. So what we're looking at here is you're looking to buy after the market closes above the upper channel. I told you 2.25 Keltner channel, ATR Keltner channel runs 20-period exponential moving average. The entry trigger is a touch of the previous day's 20-period moving average. This avoids the problem of the moving average changing during the day. Only one entry is allowed per touch of the channel. Conditions reset after entry. Rules are symmetrical to the sell side. Here are some examples of sells. These are kinds of patterns that I would very, very likely trade myself. I would look to perhaps short these. These are not particularly tradable to my eye. This might be. So each of these would be where I've marked the arrows. You can see we've touched the outer channel here and then come down to the moving average. But then we have to make a new touch of the channel to be allowed a short here. So what I'm illustrating visually here is this rule set on a chart. And here's what it gives you. If you execute this on stocks, again, let's not really get into the numbers, but you'll see your buys for stocks are positive. Your sells for stocks are negative. Also, interestingly, your sells for futures are also negative. Your sells for currencies are a lot harder to analyze statistically for various reasons, are also negative. Your buys for currencies are positive, and these are small, but they're positive. This is one of the few things that we've tested. I will tell you, and many of you know this, if you have done statistical testing, it's much easier to quantify mean reversion than momentum. But this is one of the few robust low-level tests that looks the same across all asset classes. So thinking about this, thinking about mean reversion and momentum, over a large sample of markets, if you just looked at unconditionally, you find that these things balance each other out. And that's the key. And I think that's why so many academics look at markets and come away with the conclusion that market action is completely unpredictable. Technicals are complete garbage. We shouldn't look at technicals because markets are unpredictable. Well, what I think they're missing is that there are trigger conditions that can show you when one of these forces is likely to win. And if we can, I've given you, I'm not holding things back. I've given you a set of conditions that I would consider very, very useful. That all the tests that I've shown here, please be clear, these are not trading systems. These are tests for tendencies. They're very low level tests. They're very down and dirty, but I think that it still gives you a sense that this is the way the statistical winds are blowing, if you want to think like that. If you have not thought like this, this will likely be a new and maybe challenging way for you to think about markets. Think about your trades. Are you trading flies and looking for mean reversion? And are you finding that some of your trades really get away from you? Are there conditions are there pattern? And I say conditions, but they could certainly be chart patterns that might be able to show you that it either is a good or a bad idea to do that trade. These have very practical, very real applications. Quick review of everything we've covered here. Market motion is usually, not always, random. Market motion is shaped by the two forces of mean reversion, momentum. And what we're looking for is some evidence that one force might dominate, because that gives us the potential to have a trading edge. There are patterns that capture this rhythm. Most of these patterns are based on large moves. The market somehow signaling to you that something interesting is happening. Many traditional chart patterns do this. There are two broad schools of technical analysis, which you do need to be aware of. My approach is to think functionally. What is the pattern doing? And that's why I'm not going to get sidetracked in the nuance of any particular chart pattern. And, as Tom said, this has kept me on the right side of the market with some degree of reliability, this way of thinking, because we're always trying to understand. And this does mean ignoring some noise and some things that might appear to be signals in the market. I have found, your mileage may vary, but I don't find that most applications of pattern geometry are particularly powerful. I do think, for instance, I do use a measured move. And a measured move says a market makes a move like this, and then a move like this. And then what we do is we look at the size of this move, and we kind of project this forward. All this is, it works, but all it is just a heuristic to say the market's trading like this with a certain degree of volatility. If that continues in the future, which actually for volatility turns out to be a pretty good bet a lot of times, it's one of the best bets in the market, then how's the market likely to move? And with a few other things added in to show that you're likely to have momentum on this leg, this becomes a very reliable thing. But I would be careful about getting stuck in a lot of specific pattern geometry. Quick word here about indicators. There are no magic indicators. There are no leading indicators, and there are no indicators that I'm aware of with a super strong standalone edge. A lot of indicators work, and the key to being able to use an indicator is to really understand. I think if you're going to use it, you have to understand it. A lot of people don't want to do this, right? They just want to put some line on their chart and make a decision when the line makes a little wiggle. I think that's a bad way to think about this. If you want to do it, go ahead. It's your money. But I think if you really want to use indicators constructively, you need to understand, and many of you know this term, be able to explain to me like I am 5 years old. What is this? What is this indicator doing? I do think you should be able to work the math by hand. And for some indicators, that's kind of rough. Even RSI, and RSI is an indicator that does actually have a quantifiable edge. But if you sit down to work that thing by hand, you should do it. If you use RSI and you can't do that, you're shortchanging yourself. But if you sit down to do that, you're going to discover that's kind of tricky. And one of the things, this is in my first book, you really want to understand how your indicator reacts, what it's really showing you. And I imagine, I'm not a pilot, but, I imagine when a pilot looks at an instrument on a plane, like this degree of understanding is there, like what's the airspeed indicator actually showing me? When might it be lying to me? And understanding when your tools might be lying to you is very important as a trader too. And one thing that I have done is created some kind of weird data series to feed indicators so you can develop a intuition of what they do. Do also be careful of overlap. I'll just say that, you're probably better with fewer indicators. Kind of to bring this all home, I think we've covered everything here. It's really about finding a set of things that both respects the reality of what's going on in the market and that clicks for you with your personality, with your risk management decision. The technicals are important to me. They're vitally important. But one of the reasons trading is so hard, which we all discover pretty quickly, is that everything matters. And you have to have everything from execution to psychology to lifestyle setup to support profitable trading. And then, of course, there has to be some ongoing evaluation to make sure things keep working. Technicals aren't the answer to everything, but if you don't have any idea what the market's going to do, it's really hard to make money. I think if you are not incorporating technicals, and look, just start with the big move idea. And I showed you several different ways to think about that and quantify it and see if some of some of your losses avoidable, were there trades where you might have allocated capital differently if you'd been able to have that signal. And over time, if you continue to think about these things, I'm certainly happy to entertain questions both now and later. I'm very interested in helping people build a toolkit that works for you, and if you have a good technical toolkit, put you on the right side of the market, and that's enough. Do we have any questions, Tom? How do you do things? I'll just leave my slide up here with my contact information, and we can kind of keep going here.
Yeah, there aren't any questions yet.
Okay.
You were talking about a pilot. I was a pilot in the Air Force.
Yeah, I know.
I had an instructor one time said the hardest part about flying is knowing what easy thing to do next, and it's kind of like trading too. What do you look at? And each individual thing's not that difficult, but putting it all together is the hard part.
There must also be some comparisons with, I imagine a lot of flying a plane is pretty boring until it gets pretty scary, right?
Yeah. I mean, that's why there's airline pilots, right? I mean, you can automate everything on an airplane, even the landing, but when things go wrong that the engineers didn't account for, you need somebody with a human computer up there working.
Yeah. Yep.
Let's see. Alan asked, do you use supply, demand, or pivots?
So when people talk about supply demand, my understanding of that, one of the problems of talking about all this stuff is that words mean different things to different people, and people define things differently. As people define supply and demand as what I would consider to be support and resistance, it certainly is an aspect of how I look at markets. Pivots are an aspect of how I look at markets. They're very important from the standpoint that, if you have, let's say, just very obvious example, you have an all-time high. Well, I think a stock is probably going to act a little bit differently around that all-time high, but it will also act differently around really visible chart points too. So yes, I'm aware of those things, but I'll tell you one thing that that really made a difference for me when I thought about support and resistance. Don't tell yourself this thing's coming into resistance or coming into support. Make yourself attach the word probable or likely. And I know that seems kind of, pedantic, it seems kind of academic, but if you say that we're coming into support, that creates an implication of certainty that probably isn't really there. And if you remind yourself attaching that word, this is likely support. I think it's likely support. I think it's probable support. It might be support. That puts you in a mental framework where it all goes back to that probability, right? But you're more prepared to interact with the market on the market's terms in this, sea of randomness and probability. So it's a silly thing, but I am aware of where likely support and resistance are on charts. I don't think they're as important as most people think they are. I would almost never trade against what would be a perceived support level. That's not a reason for me to put on a trade, but it is something that informs the way I look at a chart. So I can't say, I can't say with fairness I never look at it, but it's not a super important thing.
Let's see. That's the only question so far. I know you didn't really talk about it much, but you do have a free trading course. It's pretty interesting. Maybe you want to talk about that for a second?
Yeah, I do, and it's something that we're looking at revising because it's it's deep. Okay, I don't even really know what to say about it. There are several universities that in Europe that have contacted me and are using pieces of it in in academic coursework. So it's that degree of rigor, which I think is a little bit unusual in the trading community. It's something that really asks a lot of you. There are a lot of exercises. It's completely free. It's, I don't know, 30 hours of video. There's a 350-page book. One of the books you bought is the workbook for that. Most of that workbook is, or at least the exercises that go with the course are available for free. So it is truly out there as a resource for people. Over the years, I think almost the last count, almost 20,000 traders have been through part of the course. Many traders do not finish, say it is difficult. The people who have, I have some questions here in the chat too. Maybe you see them. The people who've been successful many times come from professional backgrounds. So like a lot of old floor traders who were trying to make the transition to the screen have found it useful. But, I'd encourage people, go through it. We are looking for ways to put some more, we may be able to put some more like guidance around it to help people get through it. But it's been a huge passion project for me, and you can check that out at marketlife.com.
Okay, I think you are also coming out with an options course. Am I correct?
We do. Yeah, we do have an options course, which I'm very excited about. It is 95% done, and we've shared it with some of our long-time members and gotten some good feedback. It's an approach that is. So I'll tell you, this is my third attempt at doing an options course, and I had the other two I ended up throwing out because I could not strike the right balance between, look, you got to go into these things in a certain amount of depth, right? Like I think that if you people will say, for instance, the Greeks aren't important, and well, they aren't until they are. And I think there are things that you can't possibly understand about your trading and your positions unless unless you understand the Greeks. But what I think I've been able to build into this course is a way to take these concepts and to help people build the right degree of intuition around these things. So, understanding the implication of different degrees of moneyness, different degrees of timed expiration. We're going to be releasing that publicly within weeks. I'm working on one last piece of it, and then that will probably be an evolving project with more ongoing live trades plugged into it over the years as we go along. But that's been a very exciting project here over the past, it's funny, you work on something for years and then you never quite get it right. And then it seems like you just sit down and do it in a month and a half. But really it was the struggle of doing it wrong quite a few times behind it too.
Like when I was doing my paper for my MBA, it took me a couple of years because I just I had the momentum to start just wasn't there. And once it got going, it hardly took any time at all. But another question, I really enjoy the daily commentaries you have on the markets, and we talked about separating that out to only the general market commentary.
Yes.
Have you given any thought to that, or?
We have done that. We have it, and we're going to make it available for. We're not going to make it available publicly. It's just going to be for you and your folks, and we basically have the infrastructure in place to do that. And we'll be getting that to you very, very soon. We've been doing some reworking on the website, which, and my partner Tom is a pretty good web developer and gets pretty deeply into that. So that took a little bit longer than, hey, just throw this thing up, because he's been also doing some behind the scenes work. But we again will have that to you well before the end of the year.
Oh, fantastic.
And I appreciate, I'm really grateful for your interest in that. It was something we had never considered doing, but I was aware that, because we actually had a way that people could see some of those things for free. And I said, there's really a lot of value in that general market commentary.
There is.
And so we figured out how to rework talents. That wasn't a part of it, but your interest in that really made us think about it in a different way. And I'm excited to be able to put that out there for your people.
Great. Well, we really look forward to it. I enjoy it. I look forward to watching it every day. So thank you so much for your great insights. Really appreciate it.
Thank you.
And thank you again for the presentation. It's always nice to see some technical analysis stuff. Many people in our community don't do that, so it's nice to maybe reorient your thinking a little bit and try and get some technical analysis information in your trading.
Well, and I hope this is, I realize that this might, one of the complaints people have sometimes when I do a presentation like this is they feel like it's kind of evasive, like, oh, you weren't really telling us the good stuff. I think I told you the important stuff today, but if I'm happy to come back, and if you're, see how the discussion, propagates in your community. If people want me to do more of a traditional thing with like looking at a lot of charts and talking about things practically, I'm happy to do that. In fact, I started this presentation going down that road, and then I thought, I really want to tell people the foundation of how I think about markets. So I'm certainly happy to come back and look at it other ways too if people want that.
Yeah, maybe when your options course is ready, maybe come back and do a quick overview of it.
Oh, fantastic. Thank you. Yeah, we'll do that.
All right. Well, great, Adam. I think we've taken everybody's time here, and time to wrap it up. So have a great holiday season. Good luck with the different things you're working on, and we look forward to more contact in the future.
Thank you. Appreciate the opportunity to be here today, and be well. We'll talk soon.
Yep. Thanks, everyone.